Hi, viewers. We're back again this week with what's buzzing in the world of economics and finance. Let's jump right into it. Middle East tensions flared dangerously this week as the fragile, 3-week-old U.S.-Iran ceasefire teetered on the brink of collapse following severe clashes in the Strait of Hormuz. The escalation ignited after Iran attacked 3 commercial vessels to assert hegemonic tolling rights over the strategic waterway, provoking a massive wave of retaliatory U.S. airstrikes. While President Trump explicitly declared the primary truce over and levied fresh sanctions on Tehran, back-channel indirect diplomacy facilitated by Qatari and Omani mediators managed to pause fresh hostilities by the weekend to keep future structural peace negotiations alive. The outlook points toward a highly volatile environment where ship-in traffic remains fraught. The International Monetary Fund, IMF, downgraded its 2026 global growth forecast to 3.0% in its newly released July 2026 World Economic Outlook update, warning that a negative supply shock from the Middle East war and stalling disinflation are weighing on the global economy. The report highlights a highly uneven, cross-current economic landscape. While the IMF revised its global headline inflation forecast up to 4.7% for 2026 due to wartime energy price shocks, a powerful, demand-driven AI technology cycle has simultaneously cushioned the macro blow. The Fed June meeting minutes released this week revealed a deeply divided central bank, with a significant majority of policymakers signaling a readiness to hike interest rates if sticky inflation persists. Officials emphasized that monetary policy must remain restrictive for a prolonged period, heavily downplaying market expectations for near-term easing and noting that the bar for executing any rate cuts remains exceptionally high. The People's Bank of China, PBoC, officially reaffirmed its commitment to a moderately loose and accommodative monetary policy stance this week, vowing to keep market liquidity highly abundant to counter a stubborn domestic demand slump. While the PBoC has refrained from broad, headline benchmark interest rate or reserve requirement ratio, RRR cuts, since May 2025 to protect commercial bank margins, authorities emphasize that they will double down on targeted structural credit injections. This policy is designed to lower total social financing costs and artificially stimulate price levels, especially ahead of highly anticipated second quarter GDP data. Canada's merchandise trade surplus unexpectedly widened to a 4-year high of $4.24 billion, markedly outpacing consensus market expectations of $2.7 billion and building upon an upwardly revised $3.41 billion surplus from the previous month. The outlook points toward a robust, export-led rebound for Canada's second quarter GDP, helping the economy break out of its recent multi-quarter stagnation. However, macroeconomists caution that May likely represents a high watermark for trade balances. The subsequent softening of global crude oil prices and the localized clearing of Middle East supply routes will likely deflate the windfall energy export values that previously buoyed Canadian ledger books. The People's Bank of China unveiled an aggressive 11-point policy package this week to expand the global use of the renminbi, RMB, by deeply integrating mainland and Hong Kong fixed income and offshore currency markets. The core of the package more than doubles the size of the HKMA's RMB business facility from 200 billion to 500 billion yuan, $74 billion, providing foreign banks with unprecedented offshore RMB liquidity. Canada's national unemployment rate unexpectedly fell to a 6-month low of 6.5%, edging down 0.1 percentage points from May and beating consensus Wall Street forecasts that it would hold steady at 6.6%. The Statistics Canada Labour Force Survey revealed that the economy added a net 18,200 jobs, comfortably outperforming the 10,000 positions projected by analysts. While this print signals continued resilience following May's explosive hiring surge, the underlying data reflects a softer structural mix. Employment gains were overwhelmingly concentrated in part-time positions and the services sector, which successfully absorbed a substantial influx of youth and summer student workers. Conversely, manufacturing shed 17,000 jobs, wiping out its prior month gains as ongoing US-made trade tariff friction weighs on industrial hiring. Andy Burnham's inner circle has split sharply over how to address the UK's persistent cost of living crisis. Key figures are urging him to launch aggressive, immediate intervention packages to ease elevated consumer prices, while more fiscally conservative advisors are cautioning restraint. To bridge the divide, Burnham has proposed a long-term 10-year plan focused on Manchesterism, a structural strategy that aims to permanently lower utility costs by bringing water, rail, and regional bus networks under public control, alongside executing a massive post-war scale council house building program to relieve private rental duress. Moody's Ratings maintained Japan's credit rating at A1 with a stable outlook this week, shrugging off immediate fiscal anxieties, despite a massive, looming government spending blueprint. The agency's neutral stance comes even as markets grapple with a ballooning budget that reached 122.3 trillion yen and an ambitious, newly unveiled 14-year, $370 trillion, $2.3 trillion long-term economic investment roadmap. Moody's noted that risks remain balanced due to Japan's domestic debt control and the yen's enduring global reserve status. The firm emphasized that significant execution risks remain. European Union officials pushed back against the banking industry this week, arguing that Europe's lenders are being dragged down by a chronic lack of scale rather than high regulatory capital requirements. As the European Commission prepares to unveil long-awaited banking sector competitiveness proposals, Brussels is signaling that its upcoming regulatory revamp will explicitly reject the broad capital cuts and rule relaxations that major European banks have lobbied for. Thanks for watching. Remember to like, share, and subscribe to this channel. And see you next week.